I think oil is going to be the major focus right now till the end of the trading day. I mean, everyone's focused on what we expect out of China and the dinner that we're going to have Saturday, but that's going to play out Monday more. Today we saw oil break below 50. We saw it rally again. Now we're seeing it sell off again based on some of the expectations of an output cut. So that was really, I think, the impetus to see the market rally, and that's surprising because oil maybe would have been carrying us at some point in time. But as Bob just said, we've seen other stocks take the lead here. We've seen healthcare strong. We've seen the financials act pretty well despite a 10-year yield even coming in.
Yeah, I mean, Jack, how do you explain the action that we've seen in bonds, 3%? And do you think it's all because of the Fed that we saw such a strong week for U.S. stocks, some 4% plus jump for the S&P 500?
No, absolutely, Sarah. Look, in fact, I think one of the ancillary effects of what happened the other day is there was an immediate steepening of the curve, and then all of a sudden we started to see it flatten out. One of the reasons for that is because the market flattens out when it's at the end of the tightening cycle. And that's exactly where we're at. That's the signal that Jay Powell gave us the other day. So you had this rush for yield. So think of the pension funds, think of the endowments that all now look at that 3% yield on a 10-year, and their eyes get real big. So that's exactly what seems to be happening. Now, the other part of that equation is that you're winding up a bit of a spring. Remember, there's been a lot of liquidation over the course of these last couple of months. That money does not just sit in cash. It literally goes into the bond market, into fixed income, and as a parking spot temporarily. When it gets redeployed, and a lot of that, just like you heard, will depend on what the headlines might or might not come out this weekend, you could literally see a tsunami of capital hitting the market. And it's one of those things that people were not expecting a few years ago, and we saw a bit of a melt up towards the end of the year, and we're starting to see the same thing develop now.
Chris, clearly the Fed has had an impact on markets this week. Has it fundamentally changed your outlook for 2019 and how positive or negative U.S. equities could be?
No, not really. I think the big news out of Chairman Powell earlier this week might have been misread a little bit by equity markets. Bond markets seem to get it right towards the end of the cycle. And I think that's the key. We're at an end of a cycle. We think we're past the big peaks of profitability, margins, and economic growth. And it'll just slow from this great environment now to something that's really just more good. But good may be good enough. It's just going to be a bit more selective. I think what you're set up for as you go into the end of the year, at least in the equity market, is maybe a bit of rotation. I do agree that there's a bit of wall of worry in terms of money potentially coming in. But I'd look at some of the beaten down sectors, particularly if you get a little bit of defensive rotation in this great to good story that we think develops in 2019.
If you look at the monthly performance here, month-to-date performance, Matt, you got at the very top healthcare winning by a milestone. And then some of the losing groups, technology, energy, communication services. What does that tell you?
Well, they're looking for new leadership. We were concerned about if technology didn't lead us, this market would fail. We kind of felt that earlier this month with technology failing. Where was this market going to go? Well, it's got plenty of places to find, and healthcare is going to be one of them. Probably pays nice yield on top of it. So, there's money to be had in certain sectors. Oil is going to be one as people are going to look at in 2019. Is there plenty of risk reward there?